Rising interest rates can significantly impact the bond market in several ways. First, bond prices fall. There's an inverse relationship between bond prices and interest rates. When interest rates rise, the prices of existing bonds typically fall. This happens because new bonds are issued with higher yields to reflect the new higher interest rates, making the older bonds with lower yields less attractive. Investors will demand a discount on these older bonds to compensate for their lower returns. Second, reduced bond yields for investors. If you hold bonds and interest rates rise, the yield, or the return on your investment, on those bonds may seem less attractive compared to new bonds issued at higher rates. This can lead to a decline in the market value of your bonds. Long-term bonds are more sensitive to interest rate changes than short-term bonds. This means that when interest rates rise, the prices of long-term bonds usually drop more than those of short-term bonds. Investors in long-term bonds may experience greater price volatility as a result. Rising interest rates can also affect the reinvestment of coupon payments, which are the periodic interest payments from bonds. If rates increase, investors may find that they can reinvest their coupon payments at higher rates, which can be beneficial. However, if an investor is holding a bond to maturity and rates have risen, the overall return might be lower than what could have been earned by investing in a new bond with a higher rate. For new bond investors, rising interest rates can be beneficial because they can purchase new bonds with higher yields. However, they may also face the risk of entering a market where bond prices are declining, which could lead to initial losses on their investments. Overall, rising interest rates can lead to lower bond prices and increased volatility in the bond market, but they can also create opportunities for new investments at higher yields.